Picture this. It's a Tuesday morning. You're still in your pajamas, coffee's brewing, and your phone buzzes. $3,400 just hit your account. You didn't clock in, you didn't answer emails, you didn't do anything. That's dividend income. And the question everyone wants answered is, how much money do you actually need invested to make that your reality? The number depends entirely on how much risk you can handle. And today, I'm going to give you 3 real portfolio tiers: $300K, $500K, and $1 million, with the actual ETFs, the actual allocations, and the actual income each one produces. And at the end, I'll go over 3 mistakes that quietly destroy dividend portfolios, costing people their entire life savings. No fluff. Let's get into it. Before we talk portfolios, you need to know your target, and most people get this wrong because they assume you need to replace 100% of your income. You don't. Financial planners widely use the 80% rule. Most people spend less in retirement than they did while working. The U.S. median household income sits around $80,000, so 80% of that is about $64,000 a year. Now here's where it gets interesting. The average Social Security benefit in 2026 is roughly $22,000 to $24,000 per year. That means your portfolio only needs to generate about $40,000 to $42,000 annually to close the gap. Not $80,000, not $64,000, just $42K. That's the number we're building toward in every single portfolio I'm about to show you. The 4 tools. There are 4 types of investments that go into these portfolios, and each has a job. But before I go over these, if you like more content like this, please make sure to subscribe to the channel. It's free, and it helps out a ton. With that said, let's get back to the video. First, your foundation ETFs, things like SCHD and VYM. These are boring, and that's the point. SCHD has grown its dividend at roughly 10% per year on average over the last decade, holds over 100 quality U.S. companies, and costs you just 0.06% per year in fees. They won't make you rich fast, but they're the concrete foundation. You wouldn't skip it just because concrete isn't exciting. Second, covered call ETFs. This is your income engine. ETFs like SPYI and QQQI hold a basket of stocks, then sell call options on those holdings to collect premiums, and those premiums come to you as monthly distributions. SPYI is running about 11.7% yield right now, both tied to major indexes, high income, monthly payments, and largely tax-efficient through a ROC structure. Don't worry, this will be explained later in the video. Important caveat, these funds are relatively new, most under 5 years old, so they haven't been fully stress-tested through a major crash, so we should size them appropriately. Third, a growth component, usually VOO or a broad S&P 500 ETF. The yield is only around 1.2%, which looks terrible next to QQQI, but here's the thing. Inflation at just 2.5% per year means your $42,000 target becomes $68,000 in 20 years. Without something growing your principal, your dividend income slowly loses purchasing power. VOO is your insurance policy against that. Think of dividends as your paycheck and VOO as your 401k. You need both. Fourth, a wildcard allocation, high yield or speculative plays. These can add meaningful income but carry real risk. The rule I give to everybody: if you can't clearly explain how a fund generates its yield, don't put more than 5% of your portfolio in it. Use it as a spice, not the main dish. Now, before the portfolios, there's one concept that will save you thousands in taxes and prevent you from falling into a trap that wrecks a lot of dividend investors: the dividend spectrum, the lesson nobody explains properly. Think of dividend income as a spectrum, a dial that goes from slow and steady all the way to high octane. On one end, you have qualified dividends, the kind that come from ETFs like SCHD. The yields are modest, around 3.3% right now, but here's the part that stops people cold. If you're a married couple with taxable income under $98,900, you pay 0 federal tax on these dividends. 0. That's confirmed in the IRS 2026 tax brackets. On the other end of the dial, you have ordinary income dividends, where your yield might look like 15% on paper, but after taxes at your marginal rate, which can hit 37%, that number shrinks fast. Then there's a middle ground called ROC, or return of capital, which is how a lot of covered call ETFs distribute income. ROC gets misunderstood constantly. People hear return of capital and think the fund is just giving them their own money back. That's not necessarily what's happening. In well-run funds like SPYI and QQQI from NEOS, the ROC label is largely a tax classification for income generated through option strategies. If the share price isn't declining, the distribution is real earned income. The IRS just puts it in a different tax box, which actually works in your favor because it's tax deferred until you sell. The key thing to watch is NAV. If the fund's share price keeps drifting lower month after month, that's when ROC becomes a real problem. But if the NAV is stable or growing, you're in good shape. The bottom line, after-tax yield always beats headline yield. Keep that on a sticky note. The 3 real portfolios. Here's where it gets concrete. At $300,000, you're working with the tightest margin. To hit anywhere near $42,000 a year, you need to lean heavily on covered call ETFs. A reasonable structure is 50% in QQQI, 30% in SPYI, and 20% in SCHD. That gets you roughly $32,000 to $33,000 in annual dividends. Add Social Security, and you're mostly close to your target. But I want to be straight with you. This is the high-risk tier. A severe market downturn hits a QQQI-heavy portfolio hard. If $300K is your full nest egg, keep 6 months of expenses in cash completely outside this portfolio as a buffer. Non-negotiable. Next one. At $500,000, you have real room to breathe. Here's how I'd structure it. 15% in QQQI, 20% in SPYI, 35% in SCHD, 25% in VOO, and 5% in a wildcard position. That portfolio generates roughly $31,000 in dividends annually. Add Social Security, and you're sitting at $53,000 or more per year, comfortably past the target. Now, you'll notice that actually produces less raw dividend income than the $300K portfolio, and that's completely intentional. The SCHD and VOO weighting trades short-term yield for long-term stability. You're not optimizing for the biggest check today. You're optimizing for checks that keep coming for 30 years. Next one. At $1 million, you don't need to chase yield anymore. At this level, I'd shift toward 35% SCHD, 25% SPYI, 20% VOO, 15% QQQI, and 5% wildcard. That structure generates close to $69,000 in dividends annually. Add Social Security, and you're well past $90,000 annually. And here's something a lot of people at this level don't realize. At $1 million, you could replace the wildcard slice entirely with Treasury bills or CDs and still hit your target comfortably. You've earned a right to be boring. The 3 mistakes that quietly destroy dividend portfolios. These 3 mistakes come up over and over, and they're worth hammering home. Mistake 1, chasing yield without checking NAV. A fund paying 25% that's also losing 15% of its share price every year isn't making you money. It's returning your own capital in small checks while quietly shrinking. Always pull up a 2-year price chart. If the line is trending down, that dividend is an illusion. Mistake 2, ignoring expense ratios. SCHD charges 0.06% per year. Some covered call ETFs charge 0.68%. On a $300,000 portfolio, that difference is over $1,800 out of your pocket every single year, automatically, before you see a dime. The fund manager gets paid whether you profit or not. Know what you're paying. Mistake 3, and this one is especially for the younger viewers. Building a dividend portfolio while you're still in accumulation mode. If you're in your 30s loading your Roth IRA with SCHD to collect quarterly dividends, you're slowing yourself down. Every dollar parked in a 3% dividend ETF could be compounding at 9 or 10% in a growth fund. Dividends are a retirement spending tool, not an accumulation tool. You wouldn't start eating your birthday cake while it's still in the oven. Get to the number first, then switch the strategy. The goal here isn't the highest yield, it's the most sustainable after-tax income that outlives you. And depending on where you are, 300K, 500K, or on your way to $1 million, there's a real path to making this work. Drop a comment and tell me which tier you're building toward. I read every single one. And if you want to know exactly how to grow your portfolio to these levels in the first place, because how you grow money is completely different from how you live off it, that video's up next.